Hey guys, welcome back to the channel. Today we will be talking about bonds. What is a bond? In simple terms, a bond is a loan made by an investor to a borrower. When you as an investor buy a bond, you are now an owner of that bond and you are loaning your money to a borrower, which is typically a corporation or a government. Now when a company or a government wants to raise money or capital, there are really two ways they can go about it. They can issue stocks by going through an initial public offering or an IPO, as we discussed in a previous video. That will be linked here. But if they don't want to issue stocks, they can take on debt and issue bonds. Think of a bond as an IOU. For example, if you go out for dinner with your friend and they can't afford their dinner, or maybe they simply forgot their wallet, you can loan your money to your friend and pay for their dinner. This is basically what a bond is. You loan your money with the expectation that your friend, the borrower, will pay you back. Now with your friend, when you loan your money, it is informal. There aren't any details involved with the loan, like a specified date of when your friend must pay you back, or any expected interest. This is because it's informal and they are your friend. However, as an investor, when you buy bonds and loan money to a company or the government, there is a formal contract in place. This means that you are now considered a debt holder of the borrower, meaning that the borrower has a financial obligation to you, and in the formal contract there are details. These bond details include the end date of when the principal of the loan is due and must be paid back to the bond owner. This is referred to as the maturity date. There also includes terms and details about variable or fixed interest payments made by the borrower. Now let's talk about the borrowers, also known as the bond issuers. Bond issuers such as the government or corporations are looking to raise capital and are in need of money. Governments can borrow money to fund roads, schools, or other infrastructure, and corporations can borrow money to buy property, buy equipment, do research and development, hire new employees, or fund other activities to grow their business. Now you might think, why can't borrowers, such as the government or corporations, just go to the bank? This is because some projects typically need far more money than a bank can provide. By issuing bonds, it allows thousands of investors to lend a portion of the money needed by the borrower to generate enough capital for these corporations or for the government to fund these big projects. So how do bonds work? Let's say, for example, the city of Vancouver wants to build a new ice rink for the Vancouver Canucks. The city can issue bonds that you can buy in order for them to raise capital for their ice rink. There are three components to any bond. There's the face value of the bond, the maturity date, and the coupon rate. When the city of Vancouver issues a bond, they can issue a bond with a face value of, let's say, $1,000. The face value is essentially the cost of the bond. As an investor, the face value is usually what you will loan and is also known as the principal value. In addition to the face value, the City of Vancouver will also outline the maturity date, which is how long the bond will be issued for and when they promise to pay back your $1,000. They can have a 10-year, 20-year, or even 30-year maturity date, meaning that you could end up loaning your $1,000 for a long period of time, but at the end of the maturity date, they will pay the principal value back in full. In order to incentivize investors to provide the $1,000 loan and buy the bond, the City of Vancouver can agree to pay a fixed annual interest rate. This is also referred to as a coupon rate. So an investor can buy the bond at a face value of $1,000 and a 10-year maturity date, and the City of Vancouver can add a coupon rate of 5%, meaning each year the City of Vancouver will pay a 5% regular fixed interest rate for the length of the bond. And then when the bond reaches its maturity date, the investor can then redeem their bond and the City of Vancouver will return the principal value back of $1,000. This helps both the City of Vancouver build their ice rink and is a good investment for the investors as they received regular interest payments and they got their initial principal investment back, which was the $1,000. Now, when investing in a bond, you're receiving a very predictable source of income year over year, and you can actually calculate exactly how much your investment will earn. This is where we get the term fixed income, because the interest we receive from the bond will be fixed. No matter how well or how bad the economy does, you will earn your fixed interest rate of return each year until the maturity date. Now this can be both positive and negative. Let's say you bought a bond with a 5% coupon rate. This means each year you will receive a 5% interest rate until maturity. Now, if the economy isn't doing well and interest rates are low, let's say hovering around 1%, but you previously bought this bond with a 5% coupon rate, then you're doing fine. This is a positive because you're actually earning a 4% premium interest rate compared to the actual economy. However, if the market is doing well and interest rates begin to rise to, let's say, 10%, but you are locked in and you bought this bond with a 5% coupon rate, then you have a limited capped upside and you won't benefit from the high interest rates and the strong economy. This is the reason why bonds are much more conservative. They are a relatively safe and predictable investment, and why many investors who have low risk tolerance, like older individuals or people who can't afford to ride the volatility of the stock market, this is why they invest in bonds. However, it is important to note that bonds are still not immune to risks. A risk that bond investors can face is the possibility that the issuers go bankrupt and can't pay back the debt that they owe, such as your principal investment. This is also known as default risk. Typically, bonds with higher default risk come with higher coupon rates, but the amount of risk all depends on the financial stability of the issuer. You could go for a more low-risk, conservative, stable bond investment through the Government of Canada because the odds of them going bankrupt and not paying back their debt is very slim, and they typically have a relatively low coupon rate. But corporate bonds, on the flip side, represent a greater risk of default because corporations can and do go bankrupt. Therefore, many corporate bonds offer a higher coupon rate to incentivize investors. So when deciding on which bonds to buy, you need to assess your risk tolerance. A tip is to compare credit rating agencies who assign ratings to different bonds and their risk. These ratings can help investors understand the financial stability of the issuers. It is a good idea to compare different ratings from different credit rating agencies, as they all have different sets of criteria when evaluating and rating different bonds. But always be sure that not all ratings are accurate, and you need to do your due diligence and research bonds on your own to make sure you're happy and satisfied with your investment. Another risk to consider is called interest rate risk. This is the potential risk for interest rates to change and reduce the value of any bonds that you own. As interest rates and coupon rates of newly issued bonds can rise, more investors will purchase new bonds with the higher interest rates. In order for existing bonds to attract investors, the market price or face value of the existing bonds can drop to offset the attractive interest rates of new bonds. In other words, bond prices react inversely to changes in the interest rates. To measure interest rate risk, you can look at the duration of your bond. Typically, longer-term bonds have a greater price sensitivity to interest rate changes. To protect yourself from this risk, you can try diversification of different bond maturities. Now, many investors use a mix of stocks and bonds to pursue their investment goals. And because bonds are different from stocks, they can help you diversify your investments and protect your portfolio returns. I hope this video gave you a stronger understanding about bonds and how you could use them as an investment. But as always, be sure to do your research, and before you invest in anything, be sure to invest in your own financial literacy. Thank you for watching. If you've made it this far in the video, I truly appreciate it. If you enjoyed the content and liked the video, please remember to subscribe. If you want to leave a comment, I love to read any responses and answer any questions you might have. We will see you soon. Thank you.